Hey, Dustin Tibbetts here, financial advisor with Jazz Wealth Managers. How's it going today? Hope you're having a great day here. Got a real short one for you here. I'm actually going to reference an article that was written by Amar Pandit. He's a CFA. And he says, here's 10 mistakes you avoid. He wants you to avoid while planning for your retirement. And I thought I'd elaborate on some of these a little bit because I do agree with pretty much everything that I see in this article here. His focus is on people having sort of a different view of retirement. And he sort of starts by saying it's psychological, right? A little bit in nature, and I believe that. I think it's a little more emotional, right? If we could start there and then go with the psychological thing, but that's just me rambling. Let's dive into it. Tip number one, he wants you to avoid not saving for retirement at all. It seems obvious, right? Like an obvious tip to avoid. But what he's alluding to in this article is that people tend to avoid it not because they don't want to, but because they say they'll do it later, right? And by doing it later, it costs you more. Bottom line, if you wait to save for retirement, every day you wait is just costing you more because you have to play catch up for the time you missed. Remember Warren Buffett, he's big on this whole compound interest thing. You know, he's a likable guy and sort of says this from a perspective of time. A lot of the things he says has to do with time. You need time for money to grow. And so if you wait to save for retirement until some switch goes off where then you panic, you're not going to like what you see. We calculate the actual number for every customer. What do you need to save for retirement to hit the goals that you have based on your specific life? How much you've already saved, how much you expect in Social Security, property you may have, things like that. So we work through that number. And I always sort of feel bad when it's maybe someone in their 50s and they go, look, I bought a property, I started a business, I got busy, and I never saved for retirement. So they're a little bit intimidated by that number. Requires a whole lot of planning there and sort of fine-tuning to make sure you do the right thing. Number two, not saving enough for retirement. This goes back to what I just said. Know exactly how much you have to save for retirement, then go do something else, right? Most advisors in the TV that the financial advisors on TV that are much bigger than me, they say, you got to put money away, and they try to scare you into it. I take a different approach and I say, just save what you need. Figure it out. What's your goal for retirement? Most of us don't want to travel like on a yacht for the rest of our lives. We just want to have a nice retirement and want to spend time with family and things and not stress about money. Okay, what does that translate to in terms of dollars and income and things like that? Let's figure it out, save that much, and then don't stress about it. Go do something else. Let's grow your net worth from there. We do that with all our customers. We want to help you grow your net worth, not just get you to save for retirement. That's just one piece to the puzzle there. Number three, saving without a plan. Oh boy, this one happens a lot. Unfortunately, I have a lot of customers that they go, okay, I'm supposed to put this money away. I'll do it. Go ahead, Dustin, take it, have a good time. But then there's no plan, right? And I reach out and I say, hey, let's do something. Let's talk about this. And I get no response. I can't force somebody to have a plan, but we got to have at least the rough draft of a plan. And by that, I mean, you're putting so many dollars away, but where's the best place to put those dollars? Is it all in a Roth IRA? Should you be in the TSP if you have that option to you? Should you be in the Roth TSP? Should you adjust from the 401k to the Roth IRA? Should you convert some of that money to a Roth IRA? Should you move some money from a traditional IRA to a Roth or just leave it in the traditional? What's your income like this year? So there's little things like that where we can develop even just a raw plan where you're investing all the money you need to, but you're also investing efficiently. So saving without a plan, he says, is one of the biggest mistakes. He puts it at number 3 here. I agree, right? It's a simple thing to create a plan and just dive in and get it going. Number 4, saving for retirement too late. Yeah, he's sort of saying the same thing here. If you wait to save until it is not too late, but getting later, it's just harder, right? You have to save that much more money. So I won't stick around on that one too much either there. Look, every day you wait, literally, like it costs you more dollars, right? I don't have any special stat or anything for you there. It just gets harder and harder because the dollar you invest today, let's say it averages 7% growth over the next couple of years, that dollar invested tomorrow, now you have to play catch up, right? If you wait until next year, now you're behind. You might need like $1.70, $1.80, something like that. If you put a little inflation in there as well, right? You may be already behind the game, and I get it, that's 70%, but you know what I'm saying. So don't wait, right? If you have a workplace plan, a 401k plan, go Go to your HR person and say, well, I don't know what this thing is. I don't know how it works. Just sign me up. Put a few dollars in there. And as you see your money moving, you're going to ask questions. When your money goes down, I bet you're interested then. You're going to look at it and go, why did I lose $100? What happened? And by asking those questions, you'll start wanting to do better. By learning that it's not super complicated, you will then ask more questions and be more excited about it. Number 5, living burdened with debt. I'm not one of those guys that says you have to be debt-free. If you want to be, that's okay. There's nothing wrong with that either. You can't argue someone that wants to be and is working towards being debt-free. That's a great thing. But if you're someone that says, look, a car loan's 5%. It's fair. I could buy a nice car, gets me to work. I don't have to stress about it. I'm not buying a ridiculous car, but I'm buying a reasonable car for my income and everything. That's fine. If you want to have that debt, pay it off a little early or something, that's okay. If you want to buy a house and you're like, it's 3.5%. I'm never going to see 3.5% again in my lifetime. Okay, buy the house. Maybe you'll pay it off early, maybe not. Do a 30-year loan, by the way. Don't do the 15-year loan. You can hit me with this if you like. Do the 30-year loan. You have no idea what's going to happen to your life in the next 15 years. You may need that lower payment. Do the 30-year loan. Pay it off early if it bugs you. But what we're really talking about here in tip number 5 is credit card debt, student loan debt. Credit card debt's horrible because it costs way too much. There's no reason to pay that much. 18, 19, 27% I saw the other day from one of my customers. That's a focus. You stop investing for retirement. I'll be here when you're ready, but you go pay that debt off. That's the right answer. Student loan debt is just dangerous because you can't get rid of it. If something happens to you and you can't continue to pay that student loan debt, you are not going to like what happens. So, you know what I'm saying? So credit card debt's just too expensive. Student loan debt is too dangerous. If you want to have other kinds of debt and things and you can afford it and you have your savings and you're investing for retirement, that's your choice. No, I don't think it's a big deal. All right, number 6, investing for debt at a younger age. He's sort of saying the same thing. We could have done a 4 tips video here and made this one a lot faster. But what he's actually saying here is investing in debt at a younger age. I should clarify that. What he means by this, and this is just because I believe he's from India as a financial advisor. They call him he's a CFA actually, but he's not based here in the U.S. So they say investing in debt a little more loosely than we do here. Investing in debt basically means investing too slow. If you're younger and you have an IRA or just listen, we're going to stop right here. If you are younger and you have a Roth or an IRA at a bank, if you miss everything else from here, please just take this tip number 6 here for me. Stop it. Move it somewhere else. It's not a sales pitch. You don't have to come here to Jazz Wealth. You can go anywhere you want, but move it from the bank. Why? Because you're investing too conservatively. You're investing too slow. And if you miss out on those younger years by getting that growth, that big growth, the 12% Mr. Ramsey talks about, those 7% that I think is more realistic, then you're missing out on that. It means you have to play catch up in the future. Don't play catch up in the future. It hurts you. Well, banks, they tend to invest you very conservatively. They're not bad people. They don't mean you harm. It's just their approach. They want you to see them as stable. Why do you think they put the pillars on the door, the big 4-inch glass at the window there? They want you to feel like your money is safe. They don't want you to see your money wiggling around a lot. When you're younger, you want your money to wiggle around a lot, right? You want to see the great years and you want to really be able to buy at those really discounted years. So don't invest too slow at a younger age. Number 7, not understanding the fine print. This really attributes to or goes towards annuities, I think. The fine print on an IRA, a Roth IRA, a 401k, there's really no gotchas in there. You know, we all sort of understand the tax laws. There's a few little like loophole-y things in there where you can get away with some things, but in general, we all know the rules, right? But an annuity, a variable annuity, a whole life annuity, index universal life, do you know the fine print? It's probably like 40 pages long. Right? Understand what you're getting into. I'm not going to make this a video about sort of ragging on them, but just understand what you're getting into and all the fine print, because that's a contract. You're signing a contract. You are not investing in something. You are signing a contract. And by signing that contract, just like at the gym, you are subject to rules of whatever they, sort of rules they have in there. All right. Number 8, listening to casual financial advice. I would say this leans more towards listening to more like stock tips and what the hot sector is and things like that. I don't care, right? Pot stocks, I don't care. Crypto, I don't care, right? I got to make sure that when we invest for customers, we can do so in a way where we can actually project a probability of success. I can't project a probability of success in crypto. If you want to invest in it, that's fine. Take your shot. If you like pot stocks, that's cool. I don't care. Like, do your thing. Just don't invest 100%. Don't go diving all in because you heard me say something, right? Do what's best for you. You want to invest based on advice that's best for you and not the general sort of public or whatever you see is hot at the moment. All right, number 9, spending from your retirement fund. There's not a lot of good reasons to take money out of your retirement account. Yesterday, we did a video on investing in yourself, starting a business. That's a good reason, right? I know people are going to disagree with that, but if you have to borrow from your 401k, take money out of your Roth IRA, your traditional IRA, and you have to pay some penalties or taxes on that, I don't care, right? Bet on yourself. That's a good reason. To take money out to buy real estate, you're on a fine line there, right? I'm on the fence with that one, let's say. I haven't really leaned one way or the other. But if you're taking money out because you want to pay your car off, nope. Nope, don't do that. If you're taking money out because you racked up some debt, no, man, just stop investing for a while and pay off your debt. You own up to it and pay it off. Don't go borrow from somewhere else and pay extra money and taxes and all that, create a bigger headache on your tax return. Just pay the debt off, right? So try not to spend from your retirement fund. I know they're making it easier and easier for you, but that's a separate thing. You're doing that. You've budgeted for that. Go do that. Then if you want to tackle some debt, if you want to get yourself out of a little bit of a hole, if you want to save for an emergency fund, well, that's completely separate. You make that decision what's best for you at that point. And number 10, the most important thing, getting emotional about your money. This hasn't really come up a lot because the stock market's basically gone straight up. Anytime it falls, back in February of 2018, you had to suffer through a 12-day drop. Aww. That 12 days, it hurt. It was 10%, 12 days. Where'd the money go? It started recovering right away. Back in October, November, December, you had to watch a 20% drop. It took 3 months. It took less than 3 months to recover the whole thing. That's not what I'm talking about. I'm talking about when the markets fall and all of a sudden jobs are harder to come by. Things get a little scary out there. Companies maybe starting to go out of business. Entire sectors are struggling. Retail struggles. You start noticing all these things. People are telling you about the money that they lost because they sold something and they sell it for less than they bought. You're going to get emotional. Stop it, right? Don't get emotional about your money. Make sure you have that plan. You know how you're invested. You know what you're investing for, and you know how much you're investing. If you know that, then you let those probabilities and history play itself out. You see declines and drops in the stock market as an advantage. I know it's easy for me to say that, and I try to teach our customers that when the markets are going up rather than wait for the markets to fall and then have everybody panicking. I want you to start to get your mind and your brain wrapped around, if the economy was weak, could I not buy more stocks cheaper? If the economy was weak, the pot stocks, crypto, and all that stuff, would they not be a little cheaper? Well, that's a good thing. Would the shirts at the grocery or at the store be a little cheaper? Would the cruise ship, would Disney World be a little bit cheaper? Would there be more opportunities, more sales? It's a good thing when you look at all of that, right? I want to go to Disney World so bad. I live an hour away. I can go anytime I want. There's just so many people there. I don't want to be there for that. I want things to get soft globally, right? I see it as an opportunity. Now, like I said, the first time it happens, you're going to get emotional. And that's okay. Have somebody to talk to. Have somebody to get you to not jump off the ledge. Don't listen to the people that say, I bailed on my 401k. That thing sucks. That doesn't suck. You suck. You sold too soon, right? Don't do that to yourself. Don't get emotional. Have the plan and already tell yourself, when the markets fall 10%, do you like that? Is that an opportunity to buy something 10% cheaper? Equate it to something at the store. When it's 10% less, you get excited. When the economy or the stock market falls 10%, you should get excited. If it falls 20, you should get excited. If it falls 30, you should check and make sure you're going to have your job. Everything's cool. You got your house paid up for. Everything's fine. And then you get really excited. You look for good, strong companies to add to your portfolio, right? Anyways, that's all I have for you. 10 tips today. I thought we'd keep that one short. Later, we're going to do the closing beat. We do it every day. It's just a stock market update. Do you want to know if the markets fell 10% or not? Every day I cover that for you guys, and I leave out all the opinion stuff. We just talk about what happened, the good, the bad, and the ugly, and we're playing a game. It's called Guess the Dow. If you can guess where the Dow closes at the end of a week, we'll send you $100. No strings attached. We have had 4 winners already, and Everyone can play. Like I said, there's no spam, no marketing. We're not doing that whole game. Just take your guess right on our website, and if you win, we'll send you $100. If you're one of our customers, we'll put it in your account for you. So that's all I have for you. Come check back at 5 o'clock for our live show, and enjoy. Thanks for watching.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.